So guys, here on the channel, we talk a lot about the do's and don'ts of dividend investing, but the big takeaway a lot of the time is that this is a personal journey and there really isn't one perfect way to go about it. At the end of the day, this is your portfolio and it's your path to create. With that said, there are still some ideas and general concepts that I think are important to keep in mind. And when I go to buy a dividend stock, there are certain principles I always refer back to, reminders that help me stay true to the course. So in this video, we're going to take a look at 5 questions that I always ask myself before buying a dividend stock, and hopefully they'll be helpful for you as you continue building and growing your portfolio. Now guys, this first question is undoubtedly one of the most important questions that you need to ask yourself, and I think it's the first place that you should start when considering a potential investment. And that question is, do I understand how the company makes money? Okay, before anything else, you need to know what the business actually does. You need to know what it sells, how it earns revenue, stuff like that. And Peter Lynch actually has a really good rule of thumb for this. He says, if you can't explain it to a 10-year-old in 2 minutes or less, don't own it. And whenever I do a deep dive on a company, I try and write out a super simple explanation for how the business works. Nothing super crazy, just a few sentences. As you can see, it's short, straightforward, and it's really all you need to get a high-level grasp of the business model. And if you can explain the core of what a company does in plain English, then you're off to a pretty good start. With that said too, I do want to talk about why this is such an important question to ask yourself, and there are a couple reasons. First of all, it's going to keep you from investing in things you don't fully understand. This is a mistake that I've certainly made myself, and that's a really big deal because the less that you understand a business, the more likely you are to panic and make bad decisions if and when the share price drops. And second of all, asking this question over and over and over again anytime that you analyze a new company is going to help you develop your circle of competence. Over time, you'll start to notice the industries and types of businesses you understand the most, as well as the ones you don't, and having that clarity ensures you're playing a game where you actually know the rules, and that ultimately makes you a better investor. So guys, the second question now is probably going to be a pretty obvious one, but like the first one, it's extremely important, especially for us dividend investors who plan to own our stocks for a long period of time and are counting on these holdings to continue paying and growing their dividends over that time. And that question is the business actually growing? Okay, a company can't keep paying or growing its dividends forever if the underlying business isn't growing as well. And I want to see real growth from top to bottom. I'm talking everything from the sales and revenue at the top all the way down to the earnings per share and the free cash flow there at the bottom. It's all extremely important, and you want to see all of that trending up over time. And looking at a couple examples of some companies that are doing this right, the first one that I want to look at, guys, is Visa, which I consider to be like the gold standard of stocks. When you look at this company's financials, it's really going to be hard to find a company with better financials overall than Visa. And as we can see here, revenue, earnings per share, and free cash flow per share are all trending up and to the right over time very consistently and also very aggressively. Looking at these 5-year growth rates here, Visa's revenue is growing on average by 13.25% every year over the last 5 years. Earnings per share is growing by almost 20%, and free cash flow per share is growing by over 26% on average over these last 5 years. This is just incredible growth, and this is exactly what you want to see. And then looking at another great example, guys, if you're familiar with the channel, you'll know I love this company. This is Rollins, which is one of the world's largest pest control companies, a very boring business, but these financials are far from boring, if I do say so myself. This is another great one that doesn't get talked about as much, but it's got that same steady upward trajectory in all the right places. This actually looks very similar to what we saw with Visa a moment ago. So overall, I think both of those are really solid templates that you can use to compare against when doing your stock analysis. And now, on the other hand, I think we should also look at an example of a company that's really one that you should stay away from. And I think a shining example of what you don't want is, unfortunately, Walgreens Boots Alliance. It's not all bad. I mean, the company's revenue has been growing consistently over the last decade. But if you dig deeper over here, looking at the bottom line, the earnings per share and the free cash flow per share over here, those are going to tell a different story. I mean, these have definitely been trending in the wrong direction, especially earnings, which has now been negative for these last couple of years. Free cash flow has dipped into negative territory. And the situation for this company has gotten so dire that the company actually completely eliminated their dividend, which is always sad to see. Plus, as we can see over here on the share price chart, over the long run, the share price tends to follow the company's fundamentals. So if the business is growing and becoming more valuable, then the share price will eventually reflect that over time. And on the other hand, if the fundamentals are are declining, as is the case here with Walgreens, it's going to be the same thing. And that's why this question is so important to ask yourself when analyzing an investment, because if you want a growing dividend, if you want a growing share price, then you need to make sure that the underlying business is growing as well. Anyway, guys, moving on to the third question here. This one is very simple, very straightforward, but also incredibly important. Can the company afford to pay and grow the dividend? You know, you don't want to own a company just to have it pull a Walgreens on you. And chances are, if you've already answered question number 2, then you probably already have a pretty good gauge as to whether or not the company has the capacity to do both, you know, continue paying and growing its dividend over time. And one of the simplest ways to get a quick read on dividend safety is by looking at the payout ratio. And that's going to tell you how much of a company's earnings or how much of its free cash flow is going toward the dividend payments. And once again, as a good example, we're looking at Visa. Like I said, it really is the gold standard, guys. And the earnings payout ratio historically has been about 25% or below. It looks like it's even closer to about 20% in more recent times. And essentially what this number means is that Visa is only paying out about 20% of their net income to the dividend. And if we look at the free cash flow payout ratio, it's a similar story. It's actually less than 20%. So the free cash flow payout ratio is even lower. And what this means, like in 2024, Visa is only paying out about 19% of their free cash flow to the dividend. And as investors, what this tells us when we see payout ratios here on the lower end, it tells us that the company has plenty of room to continue paying and growing that thing. In other words, when the payout ratio is on the lower side, it means that the dividend is not really financially stressful for the company to maintain. If they've got plenty of room between how much they're bringing in and how much they're paying out, then it's really not putting a lot of stress on the company to maintain or grow that dividend. Hopefully that makes sense. Now, on the other hand, looking at an example of a company whose payout ratios, in my opinion, are getting a bit concerning, we're looking at UPS here, and we can see just a few years ago, it was really in a good spot. In 2021, the payout ratio was only about 27%, but since then, guys, it has consistently trickled upward, now to the point where in 2024, the payout ratio was almost 100%, which means that at this point, the company is paying out almost all of the net income they're bringing in the form of a dividend. And that's a bit of a red flag. And we see a similar trend here with the free cash flow payout ratio, going from the low 30s in 2021 to actually being over 100% in 2023, which means that they're paying out more in dividends that they're bringing in free cash flow. So that's a really big red flag. It's come back a little bit in 2024, but still about a 90% free cash flow payout ratio. You know, it's a bit concerning. Anyway, guys, the takeaway here is pretty simple. Generally speaking, the lower the payout ratio, the safer the dividend is going to be, and vice versa. If a company is paying out most of what it earns just to maintain the dividend, then that could be a bit of a red flag. And that's not a hard and fast rule either. There are definitely some exceptions, and some companies out there can sustainably run higher payout ratios depending on how consistent their cash flows are. And Altria Group is actually a really good example of that. But in general, this is a good guideline to keep in mind if you're trying to size up dividend safety and determine how sustainable a company's dividend is going to be moving forward. But anyway, now moving on to question number 4, guys. When it comes to investing and analyzing stocks, we usually focus on why a company might be a good investment. We'll ask ourselves things like, you know, why is this a good stock? Why might this be a good investment? And those are obviously very important questions to answer. We've kind of talked a lot about that so far today. But sometimes we spend so much time thinking about it from that point of view that we tend to ignore the other side of it. And that side is just as important too. We need to ask ourselves, why shouldn't I buy this company? We need to ask ourselves, you know, what could go wrong? What is this business's Achilles heel, and what could seriously threaten or even kill this business? And this concept actually came from Charlie Munger, who was a big proponent of inverting problems. Instead of only asking why a company is a good investment, he says you should actually start out by asking why it might be a bad one. If the cons outweigh the pros, then it's probably not a company you should invest in, but if the pros do outweigh the cons, then maybe it's worth considering further. Either way, at least you'll understand both sides. But now, guys, moving on to our 5th and final question. This one is one of my favorites. It actually comes from Warren Buffett, and this is one of those great gut check questions. If the stock market closed for 5 years, would you still want to own this business? In other words, if all you had was the business itself and the dividend it pays, and you didn't know what the share price was doing, and you also had no ability to sell out of the company over those 5 years, would you still want to own it? Because if the answer is no, that pretty much tells you everything you need to know. And in this next video right over here, I'm telling you about 3 stocks that I wouldn't even feel good about owning for a day. All of these are showing some warning signs that make me think these companies could be next to cut their dividends. It's not guaranteed, obviously, but I think they're showing some pretty big red flags. So click right over here to learn about those, and I'll see you in the next one.